There are 400 million ounces of silver being traded on the COMEX right now. But there are only 98 million ounces of physical silver in COMEX vaults. If you think that math works, you don't understand what a bank run is. This isn't some conspiracy theory. It's public data from the COMEX's own reports. But you won't hear about it on CNBC. You won't read it in the Wall Street Journal. Why? Because if people understood what's happening, they'd all demand delivery at once, and the system would implode. The last time this happened was 1980. The Hunt brothers tried to corner the silver market, forced delivery, and the entire COMEX nearly collapsed. Silver went from $6 to $49.82 in 18 months before the exchange changed the rules mid-game to save themselves. And today, right now, we're looking at the exact same setup, except this time it's not two billionaires, it's foreign central banks, retail investors, and industrial users all demanding physical metal at the same time. In the next 5 minutes, I'm going to show you the math that doesn't work, the historical precedent that proves it can break, the 3 warning signs that it's happening right now. Let's break down the COMEX fraud. If you've ever wondered whether silver prices are manipulated, you're asking the right question. Because they are, and it's not even a secret. It's just that nobody bothers to explain how the mechanism works. COMEX stands for Commodity Exchange. It's part of the Chicago Mercantile Exchange Group, and it's where the vast majority of silver futures contracts are traded globally. When someone talks about the silver price, they're usually referring to the COMEX silver futures price, the benchmark that sets the value of silver worldwide. Here's how it's supposed to work. You buy a silver futures contract on the COMEX. Each contract represents 5,000 ounces of silver. When the contract expires, you can either settle in cash, close the position, and take profit or loss, or take physical delivery, meaning the COMEX delivers 5,000 ounces of actual silver to you from their registered vaults. The system depends on one assumption, that most traders will settle in cash and never ask for physical delivery. And historically, that's been true. Less than 3% of futures contracts result in physical delivery. So the COMEX operates on fractional reserves. They only need enough physical silver to cover the small percentage who actually demand delivery. But here's the problem. Right now, the ratio is completely out of control. And if it breaks, when it breaks, silver will do what it did in 1980. Except this time, there's no ceiling. As of January 2025, there are approximately 400 million ounces of silver represented by open interest in COMEX futures contracts. Open interest means active contracts that haven't been settled yet. People who currently own silver on paper through the COMEX. Now, the COMEX reports 2 categories of physical silver in its vaults, registered and eligible. Registered silver is available for delivery against futures contracts. It's metal that's been inspected, verified, and explicitly designated for delivery. Eligible silver is metal stored in COMEX vaults, but not yet available for delivery. It might be owned by someone who's just using the vault for storage, for example. As of the most recent COMEX data, registered silver is 98 million ounces. Eligible silver is 251 million ounces. Total physical silver in vaults, 349 million ounces. But remember, only registered silver can be delivered against contracts. So the ratio that matters is open interest, paper claims, to registered inventory, deliverable metal. That's 400 million ounces of paper claims versus 98 million ounces of physical metal available for delivery. Do the math. 400 divided by 98 equals 4.08. For every ounce of physical silver in COMEX vaults available for delivery, there are 4.08 ounces of paper claims on that silver. This is a leverage ratio of 4:1. Now, the COMEX will tell you this is fine because not everyone demands delivery. And they're right, historically. But here's what they won't tell you. If just 25% of contract holders demand physical delivery, the entire system runs out of silver. Not might run out, will run out. The math is unforgiving. And that 25% threshold? We're approaching it fast. In 1979, 2 Texas billionaires, Nelson Bunker Hunt and William Herbert Hunt, decided to corner the silver market. They bought massive quantities of silver futures contracts, and crucially, they demanded physical delivery. Not cash settlement, physical metal. Between 1979 and January 1980, the Hunt brothers accumulated over 100 million ounces of physical silver, roughly 50% of the entire world's deliverable supply at that time. And they weren't done. They kept buying futures contracts and demanding delivery. Every month, they'd take delivery of millions more ounces. What happened? Silver went from $6 per ounce in January 1979 to $49.82 in January 1980. A 730% increase in 12 months. The COMEX was in full panic. They literally did not have enough physical silver to meet delivery demands if the Hunts kept buying. So on January 21st, 1980, the COMEX did something extraordinary. They changed the rules mid-game. They implemented Silver Rule 7, a regulation that prohibited anyone from holding more than 3 million ounces in futures contracts and banned new purchases for delivery. You could only sell or settle in cash. The Hunts were forced to liquidate their positions. Silver crashed from $49 to $10 in 3 months. Now here's the key lesson. The system broke. The COMEX admitted, through their actions, that they couldn't handle delivery demands. They changed the rules to save themselves because the fractional reserve game was collapsing. And today, 45 years later, the leverage ratio is even worse than it was in 1980. The Hunts forced the issue by demanding delivery of 100 million ounces over 12 months. Right now, there are 400 million ounces of paper claims outstanding with only 98 million ounces deliverable. All it takes is a quarter of contract holders saying, "I want my silver," and the whole thing implodes. So, how do you know when the system is under stress? There are 3 warning signs, and right now all 3 are flashing red. Warning sign number 1, rising delivery rates. Historically, less than 3% of COMEX silver contracts result in physical delivery. In 2022, that rose to 4.1%. In 2023, it hit 5.3%. And in Q4 2024, it reached 7.2%. Delivery. Demands are accelerating. More people are saying, "I don't want cash, I want metal." This is the Hunt brothers pattern repeating, slowly at first, then all at once. Warning. Sign number 2, registered inventory draining. In January 2023, registered COMEX silver was 136 million ounces. By January 2024, it had fallen to 118 million. As of January 2025, it's down to 98 million. That's a 28% decline in 2 years. Metal is leaving the COMEX vaults faster than it's coming in. Why? Because people are taking delivery and not returning it. Warning sign number 3, backwardation appearing. In a healthy market, futures contracts for later delivery trade at a premium to spot, immediate delivery, because of storage costs and interest. This is called contango. But when physical supply is tight, spot prices can exceed futures prices. That's backwardation. It signals shortage. In December 2024, COMEX silver futures briefly entered backwardation for the first time since March 2021. Spot silver traded at 32.40, while February futures traded at 32.15. That's a 25-cent inversion. Translation: people are willing to pay more for silver they can have today than silver promised in 60 days. They don't trust future delivery. These 3 signals, rising deliveries, draining inventory, backwardation, are exactly what happened in late 1979 before the Hunt brothers squeeze. And the market is telling you physical silver is more valuable than paper claims. The divergence is starting. So who's behind this? Who's demanding physical delivery and draining the COMEX? It's not retail investors' loan. Retail can buy silver coins and bars, but they're not the ones draining registered COMEX inventory through futures delivery. The big players are 1. Industrial users, solar panel manufacturers, electronics companies, EV makers who need physical silver for production and can't risk supply. Interruptions. 2. Large institutional buyers, hedge funds and private equity firms who see the leverage ratio and are front-running the squeeze. 3. Foreign buyers, particularly China and India, who distrust Western paper markets and want physical metal stored outside COMEX control. But the most concerning player? Central banks. While central banks traditionally hold gold as reserves, several have begun accumulating silver as well. Russia, for example, has been stockpiling silver since 2014. Why? Because silver is industrial, monetary, and strategic. It's not just a store of value. It's required for green energy infrastructure, military technology, and electronics manufacturing. What I'm going to show you next is the timeline. How long the COMEX can sustain this, what happens when registered inventory drops below 50 million ounces, and the 3 scenarios for how this ends. Spoiler, 2 of them end with silver over $100 per ounce. The third ends with the COMEX changing the rules again, except this time, there's nowhere for the metal to come from. Let's walk through the math. To understand why the 4:1 leverage ratio is a ticking time bomb, you need to understand how the COMEX makes money from the system and why they're incentivized to keep leverage high. The COMEX generates revenue from trading fees. Every time someone buys or sells a futures contract, the exchange collects a fee, typically $150 to $250 per contract. With millions of contracts trading daily, this adds up to billions in annual revenue for the CME group. But here's the key. The COMEX wants high open interest, lots of active contracts, and low physical delivery, because delivery is expensive and logistically complex. Their ideal scenario is speculators trading paper contracts back and forth, settling in cash, never asking for metal. This generates maximum fees with minimal physical obligations. To encourage this, the COMEX has made cash settlement extremely easy and physical delivery intentionally difficult. If you want to take delivery of silver, you need 1. A futures account approved for delivery. Many retail platforms don't allow this. 2. Sufficient capital to pay for the full contract value up front, 5,000 ounces. At $32 Oz is $160,000. 3. A storage arrangement or transportation plan to move 310 pounds of silver bars. 4. Acceptance that COMEX approved bars are typically 1,000 Oz commercial bars, not retail coins or small bars. Most traders can't or won't meet these requirements, so they settle in cash, and the COMEX can maintain the fractional reserve game. But when industrial users or institutional buyers decide they want metal, not paper, the calculus changes. They have the capital, the logistics, and the motivation. And once the leverage ratio becomes widely known, it creates a self-fulfilling prophecy. If everyone believes there's not enough metal, they all demand delivery at once, and suddenly there really isn't enough. This is called a run on the bank, the financial term for when depositors lose confidence in a bank's solvency and all try to withdraw at once. Banks operate on fractional reserves too. They only keep 10% of deposits as cash. If everyone demands their money simultaneously, the bank fails. Same principle applies to the COMEX. If everyone demands their silver simultaneously, the exchange cannot deliver. And unlike a bank, which can get emergency loans from the Federal Reserve, the COMEX can't print silver. When it's gone, it's gone. The only options are 1. Default on delivery obligations, catastrophic for market confidence. 2. Change the rules to ban deliveries, Hunt Brothers solution. Or 3. Let the price spike until demand destruction brings the system back into balance. Option 3 is what happened in 1980. Silver hit $50, then crashed when the rules changed. The question is, what happens this time? Let's model this out with actual numbers. As of January 2025, registered COMEX, silver is 98 million ounces. Open interest is 400 million ounces. Paper claims. Current delivery rate is 7.2% of contracts. If the current trend continues, delivery rates increasing by 1 to 2 percentage points per year, here's the timeline. 2025, delivery rate hits 9% at 400 million open interest. That's 36 million ounces demanded annually. Registered inventory drops from 90 to 62 millers by year end. 2026, delivery rate accelerates to 12% as shortage becomes apparent, and that's 48 ounces demanded, but registered inventory is only 62 meps at year start. Inventory drops to 14 by year end. This is critical threshold territory. 2027, panic sets in. Delivery rate spikes to 20% plus. That's 80 Meller ounces demanded against 14 MEM available. The math doesn't work. The COMEX must either default, change rules, or let prices explode to ration demand. Now, this assumes linear acceleration, but history suggests it's not linear, it's exponential. Once the leverage ratio becomes widely discussed, and it's starting to be, delivery demands spike suddenly. In 1979, 1980, the Hunt brothers forced the issue in 12 months. Today, with social media, Reddit forums, Wall Street Silver has 237,000 members as of 2025, and institutional awareness, the timeline could compress dramatically. The critical threshold is when registered inventory drops below 50 million ounces. At that point, the leverage ratio exceeds 8.1, double the current stress level. Historically, any fractional reserve system above 10.1 leverage is considered extremely fragile. The COMEX would be approaching that. My estimate, if current trends hold, we reach critical stress by Q3 2026. If delivery demands accelerate, triggered by geopolitical crisis, inflation spike, or COMEX rule change rumors, we could hit the breaking point by Q1 2026. That's 12 to 18 months from now, not years. Months. Scenario 1, the COMEX changes the rules, Hunt Brothers 2.0, probability 40%. When stress hits, the COMEX implements emergency measures, position limits on deliveries, cash settlement mandates, increased margin requirements. This caps the price spike, but destroys confidence in paper markets. Physical silver decouples from COMEX pricing. You see premiums of 30 to 50% over spot for coins and bars. Outcome, silver. Hits $60, $80 before rules change, then consolidates. Physical holders win, paper holders get screwed. Scenario 2, the squeeze plays out fully, no intervention. Probability, 25%. Political or legal pressure prevents the COMEX from changing rules mid-game. Delivery demands overwhelm supply. Silver spikes to $100, $150 as the market clears through price. Industrial users pay whatever it takes. Speculators panic buy. Eventually, high prices destroy industrial demand. Solar companies delay projects. Electronics manufacturers substitute copper. And the market rebalances at a permanently higher plateau. Outcome? Silver $80, $120 sustained for years. Scenario 3. New supply floods the market. Probability, 35%. High prices incentivize massive production increases and recycling. Silver miners ramp up output. Governments release strategic reserves. Recycled silver from electronics and industrial waste streams increases. Within 18-24 months, supply catches up to demand. Prices spike to $50, $70, then retreat to $35, $45 as new supply stabilizes the market. Outcome, short-term spike opportunity, long-term price settles higher than today, but not catastrophically. Now you understand the math problem. 400 million ounces of paper claims versus 98 million ounces of physical metal. A 4:1 leverage ratio that's been stable only because most people settle in cash. But delivery rates are rising, inventory is draining, and backwardation is appearing. The system is under stress. What should you do? If you believe this analysis, and the numbers are public data, not speculation, you have 3 options. Option 1, buy physical silver now before premiums spike further. American Eagles, Canadian Maples, or generic rounds from reputable dealers. Accept current 10-15% premiums because if the COMEX breaks, premiums will hit 30-50%. Take possession. Don't use allocated storage or ETFs. Option 2, wait for confirmation of stress signals. Monitor COMEX registered inventory monthly, available at cmegroup.com. If it drops below 75 million ounces, that's your trigger. Monitor delivery rates. If they exceed 10%, move immediately. Monitor backwardation. If spot exceeds futures by $1 for more than 3 days, that's panic mode. Option 3, ignore it and hope the COMEX finds a way to manage the problem. Maybe scenario 3 plays out and new supply stabilizes the market. Maybe delivery rates plateau. Maybe I'm wrong. But if I'm right and you did nothing, you'll watch silver double or triple while you're stuck paying 40% premiums or unable to find physical metal at all. The math doesn't lie. 400 million ounces of paper versus 98 million ounces of metal. That's the problem. And problems that don't make mathematical sense eventually correct, violently. Full data sources and COMEX inventory links in the description. This is educational content, not financial advice, but you understand the math now. Act accordingly.